Well, I'm Rick,
And I'm Eric.
and we are your transparent wealth management hosts.
Welcome to our show.
Well, Eric, I'd say a happy Friday to you. You're looking much better than you did last Friday.
Am I? Thank you. I appreciate that.
I know you weren't
feel a
here,
lot
but
better.
I'm sensing when you came back from your buddy's bachelor party in Las Vegas
Yes.
that you may have a few words of wisdom for your other fellow millennials.
I think I do. It's your first might be your last bachelor party in Las Vegas if you only get a couple hours of sleep per night. I'll put it that way. It was a fun ride. I wouldn't not go again, but I'm not going to do it again. Let me put it that way.
Not like that.
Not like that. I'll go out there and I'll get some sleep at night. Maybe I'll come back positive from the tables. You never know. I hope for that. But
it's
took
a
its
fool's
toll.
paradise. So hopefully you got a better plan for your retirement
I believe
than you
I do.
did for this bachelor party.
Yeah, there was no plan out there.
And did you not tell me that somebody that was at the bachelor party actually had a stroke after they came back?
Yeah, one of the guys we were with had a mini stroke out there and was in the hospital for up till Wednesday when we got back. So,
I always said, you never know that it's really a party unless the cops show up or an ambulance does. So
well, we didn't get the cops, but we got the ambulance.
you got the flashing lights one way or another.
That's right.
Well, again, I think that's wisdom. I remember I was just telling you, off air that, I had my first major illness about 31, and next Wednesday you'll be 31, and I think I had pneumonia. It's the first time I started dealing with something they call non-allergic rhinitis, and it's a change of season thing that happens in the Midwest, and it affects certain ones of us, and it clearly did me, and I just never saw it coming, didn't know what it was.
Yeah. I'm hoping I can maybe steer away from it, but my body is telling me I can't do what I thought I could do.
That's right. Well, hey, when you were
You got to
20,
listen.
when you were 20, it was a little different.
That's right.
25, a little different. 31, big time different.
Yeah, it definitely is.
Yeah. Besides you, you and Autumn have a couple twins on the way.
Yeah, that'll be exciting come February. Yeah.
Yes, it will.
It'll be, I was ready for one, and now it's two. It's like, well, now I definitely have to be ready. It's a game changer.
Well, all I can say is congratulations, and
Yes, thank you.
I know you're going to be around for a long time, so
Yeah,
you gotta take care of business.
That's right.
as they say. Well, and that's kind of what we're about here on Straight Talk Clear Decisions, because there's so much information out there in the marketplace, and it's really, we hear this all the time of how confusing it is, how cluttered the space is. I love that commercial. Love to take credit for that one, where the people are walking along, doesn't matter where they're going, if they're breakfast, they're drinking their coffee, and there's a bunch of people that are dressed up in suits and they look like some kind of financial advisors, and they're just talking. It's the chatter, and then they're on the massage table face down, and the people are laying down underneath of them talking to them. And they're I think at an art museum, and the voices are standing, the talking heads are talking to them. The question is, how do you separate the wheat from the chaff? Mm-hmm. How do you really clearly focus on what you really need to do and block out the rest? Because at the end of the day, it's really what happens, and really what happens when you get there. But having this be, for most people, it's their first bus ride, their first trip down that path. And tapping into an experienced firm, not just like ours, but, we're almost 40 years combined experience. And there's a lot of experience there. We've seen a lot of people. Our joy, our passion, our love is to see people, see that look on their face when they get to the finish line and they know they can do it. And it looks like, and from a scientific standpoint, that they can actually live a financially independent life and stay retired for the rest of their life and not outlive their money.
Yeah, because what the experience does, especially in this volatile market right now, and Rick, you mentioned the noise before. I don't think there's been more than a handful of times where we've heard more noise in the marketplace. With what's going on in China, with what's going on in oil, with what's going on with our Fed, and should we raise rates, should we keep them the same, should we raise them once and elongate the process? There's a lot of noise, and if you're close to retirement, or maybe you haven't really been through a big downturn, maybe you said you were sitting in cash in 2008 for whatever reason, is this a big crash coming? I'm not going to say yes or no, but again, this isn't something, it's happening now, it's going to happen again in the future. And if you're not with a firm, or if you've not been through these before and you don't have a plan to get through this, that's typically when you make the wrong decisions.
Because when you confuse the feelings with the facts. The facts get cluttered, and if you're listening to the talking heads, and you know all the sources, I'm not going to name them, but there is so much, in our opinion, misinformation. And as I see it as a professional, and you do too, we're looking at this, and they're playing both ends. As soon as something happens, then that's all the media points, and they're playing on that, and they're playing on people's fears where they actually exacerbate the fears. And they can actually help wreck your retirement if you let them. So today we want to talk about, 3 retirement planning shockers. And, like anything else, it's a reoccurring theme on our show. We talk about the sooner you start planning, the degree of adjustment is less.
Yep.
You have in retirement planning, you have time, interest, and money. So, the earlier you start, the less principal you have to put in. The later you start, the more you have to put in of your own principal.
And Rick, how many times do we hear people, I don't need a plan yet, I'm still 10 years away from retirement. Well, if you wait until 2 years, you're planning.
And for those football fans out there, you're in the red zone.
That's right. And, you should have started this planning maybe 10, 15 years ago, because if there is something you need to change, you do not have time on your side. Whereas if you started planning in your 20s or 30s and you realize, hey, I need to make adjustments, well, you've got probably 20, 25 years left to work. And if you're 5 years away from retirement, time isn't, you have to hope a lot of stuff falls in place.
Well, and I would say this, and it's not that there aren't strategies there. We work with people every day like that. But again, just understand that if there's something really off course, then the adjustments are going to be more extreme, and the strategies and tactics are going to be more, more powerful, more imposing, because, you have a lower margin of error.
That's right.
There's a smaller window there. It doesn't mean that and a lot of folks, it doesn't mean that you've gotten everything wrong. But I think it just makes sense to utilize the wisdom of somebody who's a competent, capable advisor in our industry. And we love the end-to-end holistic model. I mean, we're partial to that because it's an integrated model that's looking at every dimension of investment, taxes, insurance protection, and estate planning. Now, we do all of those because we focus first on a process. We're not peddlers, we're planners. So we're both fee-based and we're commission-based, just not on the same dollar at the same time.
Correct.
It's called double dipping. But, if we sit down with somebody, Eric, and what they need is to go buy a product and that fixes their problem, we can tell that from a financial plan. Why would we sell them anything else? And it may sound in our industry like, hey, somebody says, hey, I'm fee-based only, and I've hooked my train with yours, and, the better you do, the better I do. Well, we do that. I'm just saying if that's all they do, that's the only trick in their bag, guess what they're selling you?
A fee-based product.
And if they go over on the other side of that and they're selling a commission-based product, we use the analogy of to the man with a hammer, the whole world looks like a nail. So that's why people get nailed, because they got one trick.
That's it. You look at taxes. Taxes, on the other hand, we don't do taxes. We partner with CPAs that do both the tax planning and the preparation. The preparation's mandatory. Everybody has to file some sort of return each year. The planning is what's optional. The planning is what can make you keep more money at the end of the day. They can go back and see if you've made any mistakes in the last couple of years, and if you did, maybe they can amend it and fix it. But if they can't, at least we know what not to do going future, if at all we can avoid it.
I think about insurance protection. It only takes one slip. Here in the Midwest, we have some pretty interesting winters, to say the least. And, if you make a mistake, you don't want to lose your entire financial security. Well, the wrong time, the worst time to find out what kind of coverages you have is at claim time.
Yep.
The best time is proactively, like many of these processes, to look at it before a claim takes place. So we have professional partners in the world of life insurance, long-term care, disability, Medicare planning, all of those aspects, and health insurance, because, it makes sense to look at it in advance and know. We say, only write a check, or buy insurance for that which you don't want to write a check for. So if you think you're okay and, hey, I can write that check should that claim occur, then, hey, don't worry about it. But if you're better off to sell that risk off to somebody else, look at that in advance. So, for example, I'll throw one in here. One that's big with the baby boom generation is looking at long-term care. and long-term care alternatives. Well, that's a big area. We'll touch on that a little bit later in the show, but needless to say, it's a good time to get probably an insurance audit and checkup probably every couple of years.
Yep. The last pillar, last piece is estate planning and elder law. Again, Rick and I, we're not attorneys, but we partner with both estate planning attorneys as well as elder law attorneys. And, you've created this wealth, you've grown your assets. Now let's start preparing and planning to distribute your assets to your loved ones, to your charities, not to hospitals or attorneys or probate courts or court costs. So doing the proper estate planning today can ensure that your loved ones are the ones that are going to get the majority of your wealth and are going to benefit the most at the end of the day.
So it's the last but not the least.
That's right.
And we should mention, Eric, that our today's program is only educational in nature. Don't consider this advice. You should certainly consult with qualified financial, legal, tax, or real estate professionals prior to taking any action. Our broker-dealer is National Planning Corporation in Santa Monica, California, and we are separate and unrelated companies. We're also registered investment advisors, which is separate and unrelated. Some of the topics we talk about and what we utilize in our practice, demographics, for example, appear to be forward-looking. Mm-hmm. However, nobody has a crystal ball. If we could see the future, we sure wouldn't be talking about it.
No, we wouldn't.
We'd be in the prophet business or something. Of course, you know what they did to prophets in the Old Testament when they were wrong?
Yeah, I don't know
they
if
stoned them to
there.
death. So
if we had a crystal ball, we wouldn't never be wrong. So we wouldn't have to worry about it.
I don't know where you can get one of those on sale. But again, these are the things that are just good to know when you're going into a process, to know how somebody approaches the problem, because then you're going to understand what their solution is. And if it's more about you, the listener, the recipient of the services here, or if it's more about the person who's giving you the information.
Yep.
So again, looking at three retirement planning shockers.
Yep.
Here's some potential ideas, 3 things that kind of come to mind that we're going to talk about today. How much you can or you cannot afford to spend in retirement. Now, as simple as that sounds, that's pretty big.
It is. The second one here is how much money you'll pay in taxes unless you create a forward-looking tax strategy. Again, nothing you can't accomplish without planning.
No, be proactive. Don't wait till the damage is done and go, oh, wait a minute, what am I going to do? Mm-hmm. The last one I'd say is that how many folks that we see are taking far more risks than they even realize, and they don't even know it. Mm-hmm. Now, what am I talking about there? Sometimes the rules in the game, the water changes. How about that for a metaphor? So you talk about stocks, bonds, cash, and alternatives as 4 investment categories, or asset classes, let's say. Well, what happens when the asset classes themselves become dysfunctional? They're not, let's say, physiological changes where they actually have changed from the norm.
Yep.
What we typically have seen in the past is not applying today for some reason. Yep. So we'll talk a little about that today. But those are 3 things that could be big surprises for you.
They could virtually happen to every one of you out there.
So, when we look at this, some ideas here that we're going to cover today, and possible solutions is, Eric, and if we said this once, I've lost track of how many times we've said, have a comprehensive financial game plan. How do you know where you're going to end up if you don't even know what the goals and the game plan, where you're aiming for?
That's right. And caddying right alongside that is keeping that plan up to date. So if you've done one before, make sure you keep monitoring. If you haven't done one, now it's time to do it and keep it up to date.
Now, it's important that a plan, and let's say a financial plan, be integrated and dynamic. And what does that mean? That it's integrated as pulling live feeds from your sources if they're trading in the market. So it's tracking it every day at the close. And dynamic means that it's making changes. It's making adjustments. It's like a GPS. The next one, create a strategy to generate income from your savings and investments, or what we call durable income. Now, the rules have changed on this.
Yes.
We'll talk about that.
Yep. The second one, or the fourth one here, is determine your risk tolerance, especially with the recent volatility we've seen on Wall Street today.
Have a forward-looking tax strategy. Well, I think we touched on that, but again, who wants to pay more taxes? You want to figure out, it's about your net and how much you can keep.
Yep. The next one here is a budget. Determine what your expenses will be. So if you haven't done a budget now, it's critical to do that budget and make sure that budget is in place before you retire.
Maximize your Social Security benefits. If this applies to you as a couple, I'll say simply, there's 81 different options for couples, and there's 9 for singles. And tens of thousands, if not hundreds of thousands of dollars and potential income, not counting legacy and other things in your other assets.
Yep. Have a strategy to pay for health care, Medicare, and long-term care costs. This is what Rick was mentioning. If you are a baby boomer, this should be one of the most important things you are maybe either watching or keeping your eye on.
What's one of the single largest expenses, right, in retirement?
Yep.
So you mentioned this, Eric, in the earlier part here. Take care of your estate plan. I mean, being proactive. You think about, this is just for my heirs. No, this is about you. Yep. If you know what that looks like, again, your plan to fix this and how they make your money last longer, and you may find out that you can actually spend more.
Yep. And the last one here is don't forget about our friend inflation. You know, inflation is big. We have to pay attention to it. And I'll be the last point here is inflation changes on, you know, depending on what time we're in. If you're just looking at history, do not take history into account on inflation, because there are different times where inflation is a lot more than the 3% or whatever you hear on TV.
Well, it's not my amigo. But stay tuned for that. We're gonna really dig down on this today in today's show. Go online and check out our website, straighttalkcleardecisions.com. There is a lot of information on there. Free giveaways, reports, past shows. There's all kinds of things that we do. We're also on the social media world.
Yep, we're on Facebook. It's Rick Saylor Financial. We're on Twitter at Ricktirement, and that's RIKTIREMENT. And we're also on LinkedIn. So get in if you're familiar with social media. We have a ton of free giveaways we post daily on the website. So get on there, check us out, follow us, like us. You'll enjoy it.
Yeah, we have a free giveaway today we'll be talking about. If you have a question and you're not afraid to hear yourself live on the show, 866-472-5790 with your live questions. We'll do those in the final segment, the third segment of today's show. And did you give them info at Straight Talk?
I did not.
Info at straighttalkcleardecisions.com. If you don't want to hear yourself on the radio, send that to us. We'll pick that up and we'll answer that question right on the air. So stay tuned. We're going to talk about the 3 retirement plan shockers and how you can better prepare for that. You're listening to the Straight Talk Clear Decisions radio show with your no-nonsense wealth management host, Rick Saylor.
And Eric Hamburg.
Money is an awesome thing if you know how to handle it, the joy it brings.
Hey, what about estate planning? An up-to-date will guarantees you're going to go through probate, and without, well, don't worry about it, the government will decide for you. The 3 enemies to an estate today are number 1, the federal inheritance tax, 2, probate, and number 3, income tax. So your choices here are you can give all your money away. That might not be any fun. You may need it. Or you can create a trust to hold those assets. And remember, you don't have to own the assets to enjoy the benefits. So a revocable living trust can help avoid the expenses and costly delays of probate, and along with a living will, power of attorney, durable health care power of attorney. So be sure and ask about our attorney partners today for a free consultation.
Rick Saylor, smooth financial sailing for the best part of your life.
Listening to the Straight Talk Clear Decisions radio show with your Straight Talk Money host, Rick Saylor.
And Eric Hamburg.
Eric, a good topic today, 3 retirement planning shockers. You know, a lot of things that people hear about, and oftentimes what the enemy really is not what you're hearing in the media.
Mm-hmm.
So again, you're going to hear the straight talk here. We're going to give it to you straight so that tell you what we would want to know.
Yeah, and how it affects you. I think more importantly, as you hear all these big terms and these big financial people speaking, sometimes it goes over your head, and once it goes over your head and you kind of disengage from it, we're here to make it simple for you, straight talk, so you understand it and you can actually create activities off of this.
And this thing, on an expanded version of this, get a copy of get a free e-subscription to our e-newsletter. All you have to do is go online and ask for it.
Yep, on our website.
Is that www.straighttalkcleardecisions.com, and right there on the left-hand side, you can request it.
Yep.
And we'll send it to you absolutely free. And anytime you don't want it, just click unsubscribe. We're not going to bug you.
Yep.
We can never send it back to you. But I think a lot of people enjoy the information that's in there. First of all, we write a view every week, that's about probably not what you're hearing in the mainstream. Then there's also a headline news, and it talks about this is what happened, this is what it means to you.
Yep. You also have an economic calendar, so you have all the reports, anything that's coming up on Wall Street. We have our speaking schedule, our events. We're big on Social Security. We just had a Social Security event here, 2 weeks ago. We're getting ready to have another one here in a couple weeks.
And we will make that available just because you physically can't be here.
Yep.
And we're looking at launching that on an ongoing basis, a weekly basis, because there are 10,000 baby boomers a day, Eric, turning 65.
Yep.
So everybody's, there's this migration into the decision-making process, let's say, and some of this has far-reaching implications, like for the rest of your life. And again, there's huge decisions to be made here. Next month's topic is both Social Security and Medicare.
Yep.
Jeff Hendricks, our Medicare specialist, will be, available for that. So if you see that on the internet, on LinkedIn, Facebook, out here on whatever, you feel free. We do have limited availability for those sessions, both in our office here in Fairfield, and then also on the internet. We have limited capacity for that as well. So we'll send you a link. You can link right in. You'll be able to hear everything. You just won't get those great snacks we serve here.
That's
and
right.
Refreshments.
They're good too.
Oh, they are good.
Sometimes
But
there's
if you
leftovers.
can physically be here, it's better. You can ask your questions. We'll be able to, again, you'll be able to ask your questions online as well. You can email them to us during the session. They'll be answered at the end. Or, actually, but you will be able to see the slides, see the information, get the idea, make requests, and get all the free stuff.
Yep.
So, kind of jumping into this topic, because, we always have a limited time. But the first thing I would say is an overview, Eric. When we're looking at the 3 retirement planning shockers, first thing that people should do is take control of the 6 biggest retirement expenses.
Yep.
So let's just start with the top one. It's basically comes down to the necessities of shelter.
It is.
Housing still remains the largest expense in a retiree's budget. Just as before, when you retired, you may think that goes away, I've paid it off. But you think about this, people over age 50 spend an average of 40 to 45% of their household budget on housing and housing-related items such as utilities, home insurance, home furnishings, gardening, and yard expenses. Now, this is one expense that you can control if you want to. You don't have to redecorate.
Nope.
You can downsize to a smaller home in a less expensive neighborhood. Some retirees move to an area of the country with a lower cost of living, which, by the way, we have some great resources for that.
Yes.
And, a lot of retired homeowners have the option to take out a reverse mortgage and put more cash in their pockets. Now, we're not a huge advocate of this. This is a last ditch. Mm-hmm. But, when you see people that have put so much money, maybe so much of their time and energy into that area, their house becomes one of their biggest assets other than maybe their retirement savings accounts and 401ks or deferred saving programs.
Yep. Second one here, and probably one of the biggest issues with baby boomers, is healthcare. This is one category of expenses that tends to increase with age. And, we're big, and I shouldn't say we're big. We follow Harry Dent and some of his macroeconomic work. And one of the big one is the pharma healthcare wave. And the pharma healthcare wave says typically in developed countries in the U.S., we peak on spending on healthcare at age 76. Well, if you've listened to any of our past shows, Rick's mentioned, time and time again, the baby boom generation is just starting. The first wave has just surpassed the 76-year mark. We've got, 15, 20 more years of baby boomers retiring and hitting that 76 mark. So if you don't think healthcare expenses and long-term care expenses and hospital bills and drugs aren't going to keep getting more and more expensive, I believe you're crazy, because we're seeing it already, and we're not even a fraction of the way through this thing.
And we got to wonder, what is the system's capacity to be able to deliver? There's got to be a lot of innovation and a lot of changes here that's going to be radical. But, it's one of these things here, and we'll talk a little bit later, I think, about some of the possible solutions here. But long-term care insurance becomes if you're not looking at this and you're a baby boomer, and again, I look at it like this. And we expand that definition. There's probably 92 million baby boomers, let's say, born between the 1932 and 1964. That's 92 million people roughly. And if you lay that down like a train, the front engine of that, the people born in 1932 are turning 83 this year. Mm-hmm. And the caboose of that train's turning 51. That train is coming into the station. And there's some dynamics that's going to impact, which also is in this next one, taxes. Taxes don't go away when you retire.
No.
It falls into that category in the cost of living that they say is inevitable. Death. Taxes, and health care. So, once you stop working, you don't get payroll taxes, but you still have to pay income tax, and you very well may be making bad decisions, wrong decisions, inefficient decisions that are causing your Social Security benefits and other things to be taxable, and you're eroding your net income. Mm-hmm. I know a number of times we're looking at people working with them, helping them, and they're saying, hey, I need to draw this, let's say, X number of dollars a month. And I say, well, yeah, we need to really kind of dial that back because you're not really keeping much of that. So we need to look at where you're drawing that from, what we call smart withdrawal strategies. So, there's going to come a time for those of us who have investments and withdrawals from IRA where it's mandatory withdrawals that could be causing this to happen. So you want to look at this in advance, have a strategy, and know how you're going to optimize. Both now it's about keeping how much you keep today, and then in the future, when you go from a paycheck to a playcheck, it's even more important.
Yep. One of the fourth things here of looking at retirement expenses is transportation. So, granted, we know we will save on commuting costs after we retire. We're not going to be driving to work every day or driving 20, 30 miles to work every day. But guess what? We still have to get around. We're not going back to horse and buggy. We got to jump in a car and we've got to go and whether it's visiting family or kids or grandkids or go to doctors, we have to drive. So maybe instead of having two cars, maybe you downsize to one car, especially if both of you are retired. Maybe it's time to get rid of that big diesel truck or that big SUV and maybe downsize to a sedan or something where you get better gas mileage and you don't have both those bills to pay.
Now, you may want to consider, relocation into a more urban setting. I was just talking to somebody yesterday, one of our wholesalers, and he was talking about how he lives in the city in Chicago and he has a car and never drives a thing. So, there may be in the demographics group we follow, predicts a migratory process or a trend where people are going to move back more to a more urban setting for that reason. The other thing that I think we see popping up, and we're going to continue to see as a trend, are these village kind of setups where the people driving around on golf carts.
Yep.
So again, you're looking at, it's a paradigm shift. Now, this is also going to dovetail. I want to talk about the fun stuff. Right?
We do like having fun.
Talk about this other stuff, all this necessary stuff. Yeah, that's cool. But, how about, travel? You think about when we're working, I only have so many days in a year that I can travel. Mm-hmm. I'm virtually going essentially from however many days that is to 365 days a year because now it's like a permanent vacation. The question is, are you going to stay on vacation? Are you going to be back in the workforce at some point in the future? But, many retirees say that travel is one of their top priorities, and we see that a lot of times. We're inputting that into financial plans, and as a budgetary item, you say, hey, for these number of years, I retire at 66. I retire at 70. For these first 10, 15 years, I want to hit all that. Because after that, I don't know if I won't be able to do it.
Correct. Your health might not be here.
So, again, that can be factored in. It should be factored in. It should be budgeted for, and you can rank it inside of a financial plan. I know the program we work with does that, and the program will adjust, to make that either, feasible or less feasible. It's going to say, yeah, that's not really feasible. So, you change the grade on it.
Correct. And the last one here is caring for kids. So this, your kids may no longer be living with you. You might not be paying for their clothes or paying to feed them, but guess what? If they have kids, now you've got grandkids you want to take care of and have fun with. Maybe there's still weddings coming up if you have to pay for a wedding or want to pay for a wedding. Or maybe you want to help them make a down payment on a home or pay some of their student loan debt off. So this is more along the lines of these are the wants. And if this is something you want to do for your kids, you better start planning now so when this day this time comes, you can afford it if that's really important to you. There's ways around it, but remember, this is a discretionary expense to you. So while paying that doctor bill and tax bill is not, caring for kids is. And I should say caring for kids. If you want to pay for that wedding or if you want to pay for their first down payment, if this is important, start planning today in order to make that come true.
Well, again, we said this in the first segment of the show, Eric, but estate planning is more than when I'm gone. One of my favorite sayings in one of our shows we did a while back was, I like to do my giving while I'm living. That way I'm knowing where it's going. And the question is, can you do that and be assured that you're not going to run out of money before you run out of life? Well, again, I'm going to mention our free giveaway here today, a financial plan, a comprehensive financial plan. Now, our entire summer series was on this topic. A lot of people take us up on this, but not enough.
Mm-hmm.
So it was actually, we talked about segment by segment, what needs to be done. Well, actually, all you got to do is send us an email. You can send it to us at info@straighttalkcleardecisions.com. Send us your email address. We'll send you the budget sheet and the questionnaire, and then you can go in, listen to those segments, complete that, have access to our program, which is an $11,000 program, and with all its components and parts. And then we'll actually critique, once you see the cracks or the holes in your picture, we'd love to be part of the solution. We say, well, hey, maybe consider this or consider that. Now, the other alternative, and I know a lot of people do this with us, for a very small and reasonable fee, we'll do it for you.
Yep.
You just contact us and say, hey, I want to know where I stand. We'll do it for a reasonable fee and tell you exactly where you stand, give you professional advice and a second opinion. I don't know how many times in our combined 40 years of service that we've looked at people's plans and they thought they were okay, and because of the program we were using, and we can explain the nuances and the differences, we have a lot of engineers and teachers, don't we?
We do.
Professional people. But, not people that are, what I want to say, I say in the flock, in the herd. These are people that are thinkers, and they've been impressed when, I remember one person, I'm not going to name him, but I just call him Jack. Well, Jack said, hey, I think I'm okay. And once we went through the details, we walked him through that. He said, wow, he went from seeing himself as successful to failure because there weren't enough pieces being looked at in that program. And believe you me, if we could get the program for free, we'd be telling you about it.
Yeah.
But we see all the free programs. They're not doing all the things. So, for example, let me just quickly recap that. You look at a financial plan, what's involved, and it's like your personal story, your financial GPS. So it's going to look at your budget, your inflows, your outflows. It's going to look at your current portfolio investment returns or losses, maybe like you're seeing now. It's also going to take into account your vision, your values, your goals. You want to travel, you want to gift, you want to do all these different things and accomplish that, and you're going to rank those. Then we're going to test those against inflation, against taxes, and against the inevitable volatility.
Yep.
We haven't seen that in a while, but it's back with a vengeance. And over the last 30 years, 10,000 different combinations. And what that's going to spit out and produce is a real simple, comprehensive, not easy, but simple readout, but it's going to look like a speedometer on a car. If you're 40 to 74 on that, you're in the red, you're failing, you're running out of money before you run out of life, most likely. If you're 75 to 99, not a guarantee, but at least you've got something that you can navigate with. And again, it's integrated in dynamics, so it's pulling live feeds and adjusting, just kind of like a GPS. It doesn't tell you what to do. In the hands of a professional, like any doctor or anybody, that has that level of expertise, they're going to be able to tell you and exactly what you need to do that's most likely going to help you with that situation.
Yep. Get on our website, straighttalkcleardecisions.com. In regards to, on top of the e-newsletter we send out once a week, we've got a bunch of other white papers and research reports, from us and from our partners, on the topics of investment, money management, taxes, insurance, estate planning. So check it out. Check out our website, straighttalkcleardecisions.com, and ask for stuff we still have available. We'd be more than happy to give it to you.
We'd love to engage you in conversation on LinkedIn, Facebook, Twitter, all these cool things that are available. I don't know exactly how all those work, Eric, but they are kind of cool.
We're getting there.
They're kind of cool. So again, you got questions. We're going to give you the answers we know, the best thing we know of, and we're going to, in the last segment of our show, get some questions. We'll answer those either from people that we've gotten over. If you have a live question, call us at 866-472-5790. We'll get you on the air to answer that question. Or if off the air, info@straighttalkcleardecisions.com. You just send us that, we'll answer it. But we're going to talk about in the last segment, again, continuing with this 3 retirement planning shockers, we're going to move into strategies and solutions in the last segment.
Yep.
And we're going to talk about some things I think that could be very effective in helping you stay on track or maybe get on track. Well, you're listening to the Straight Talk Clear Decisions radio show with your no-nonsense host, Rick Saylor.
And Eric Hamburg.
Money is an awesome thing if you know how to handle it, the joy it brings.
Hey, have you heard about the new long-term care alternatives? Many of you may know how I managed my mother's care, and I took her through her money in the spend down into the veterans benefits. My father was a 2-time Korean War vet, and right into the Medicaid. She started out at $2,700 a month in assisted living, and at the end of her life, 2 years later, was over $8,000. The 3 concerns I hear the most about long-term care insurance protection is that it's expensive, the premiums are rising, and I may never use it. Well, why don't you try what I did? I bought a life insurance long-term care. They can't cancel me, the premiums can never go up, and oh yeah, I can spend that death benefit before I die if I'm critically, chronically, or terminally ill. Be sure and ask your advisor today.
Rick Saylor, smooth financial sailing for the best part of your life.
Well, you're listening to the Straight Talk Clear Decisions radio show with your Straight Talk host, Rick Saylor.
And Eric Hamburg.
Well, Eric, we're on this topic of the retirement planning shockers, and this segment, we want to talk about some strategies and solutions.
Yes.
So the first one I just want to jump in on, we talk about, in particular, we're just looking at the market, we're seeing the indices up overall today, been pretty volatile. We've not seen what they call the VIX, V-I-X, be this volatile for probably 8 or 10 years. It's been a while.
Mm-hmm.
So, taking a look at your investments, it's a good idea occasionally to rebalance, which means you go back in, take a look at maybe your exposure to the asset classes, stocks, the bonds, the cash, the alternatives, and see maybe where you're at risk because the asset class itself shifted.
Yeah. So an example of that is we've now been in a 6-year bull market run that stock market's made over 200%.
And we're clearly in correction mode.
So
at 10%.
So if you thought you were let's call it a moderate investor 6 years ago and you had the right mix, but you haven't rebalanced a single thing since then, your stock portfolio that, let's say, was 60%, now could very well be worth over 80% of your portfolio, and your bonds that were 40 can now be worth only 20. So when this correction comes, or when because it's going to come, we just don't know when it happens, you might see a bigger hit than you would have anticipated, and it's because you haven't rebalanced, because you're out of risk, you're out of line with where you started. That's why the importance of rebalancing today, especially in this market, is going to be critical for your success in the future.
And again, being proactive in that process. So you may look and see, for example, we were talking about the dysfunctionality sometimes of asset classes. We see, bonds are up overall less than 2%, I think, on the indices we can see, this year, in contrast to the S&P 500, which is an index you can't directly invest into, but it's a gauge of the market. And overall, the stock indices are down. Some of them are underwater year to date.
A lot of them are.
So when we look at that from that perspective, the question is, will bonds save us? Well, most likely not. Mm-hmm. Question is not if the Fed eventually will raise interest rates. The question is, when will they, how much will they raise them, and what's the impact of your portfolio? Well, like a teeter-totter, when interest rates rise, bond yields drop. We know interest rates are going up. Again, we just don't know the when and how much.
Yep.
So when you look at exposure, and if you actually own the bond itself, you'll have less impact, most likely, if the bond itself is viable. So if you hold it to maturity, they're going to give you your par value. So if you paid whatever price you paid for it, then the bond's going to pay that plus the coupon or dividend has been paying. If you're in a bond fund or an exchange traded fund, that's a different story. Mm-hmm. That's like being on a teeter-totter and being out at the end of it. You're going to get whipped around a lot more.
And you don't have a consistent coupon most of the time.
No, because you're not actually getting it, the fund's getting it.
Yep.
So the second one here.
This is setting aside an emergency fund. So this is cash. So, depending on who you talk to, some people say have 3 months worth of expenses. Some say 6 or 7 months worth of expenses. It's really going to be dependent upon your individual specific situation and where your income's coming from. Is it coming from work? Is it coming from a pension from a company? Is it Social Security? And, determining how much you need. Remember, cash doesn't make anything today. Well, I take that back. It makes what? 0.001%.
That's the you owe them strategy.
So just because it's
and not surprising. I mean, with all this volatility, you've probably got
a lot of money,
trillions of dollars. Half the market's probably sitting in cash.
So you need either cash or a cash alternative today. We're not saying you don't. You just typically holding too much cash, it doesn't make anything. It's not working for you. So depending on what you want to keep, whether it's 3 months worth of expenses or whether it's 6 months worth of expenses, making sure you have an adequate emergency fund. There's going to be that day you wake up and your car doesn't start, or you need a couple $1,000 for whatever reason.
Or how about your kids?
Yeah,
your kids are crying out for money. Now, we were looking at a supplement to our piece today, and a lot of people, because they don't have either savings. Now, it's wise when interest rates are down that you just tap a line of credit, but use the credit, don't get used by it. Mm-hmm. Because in collateralized means, there's an asset behind it. So the worst place to go is probably a credit card because it's unsecured debt. And they know that. There's a default rate of whatever percentage that is, and they just add it. That's why they charge 16%. On the other side of that, if you're using a home equity line of credit, also known as a HELOC, that's like a second mortgage, and you can tap it, and it costs, whatever it costs. Sometimes it doesn't cost anything to keep that, and only use it when you need it. Mm-hmm. And that way you're not losing potential return on your money. Now, if you've got money sitting in the bank at almost zero interest, that's the first place to go. The last place most likely to go. Eric, tell them a little bit about the true cost in money when you're looking at tapping your 401k plans and your salary deferrals or your IRAs.
Yeah, let's start with IRAs. If you go, for baby boomers, the majority of your money is probably in IRAs or 401ks. So if you need a chunk of money, let's just say 10 grand, and your first place you go is at IRA because your neighbor told you that's where you should pull it from, and you go pull $10,000, and let's say your tax bracket is 20%. If you pull $10,000 from a fully federally taxed account and you've got a 20% effective tax rate, that $10,000 just costed you 20%, or in this case, $2,000 to get the access to that $10,000. Whereas maybe if you had a line of credit and that line of credit cost you 3%, and in this example, you just saved 17% just because of where you pulled it. Not how much you pulled, it's where you pull it from, and how you pull it is going to determine, how long is your money going to last? And if it's a 401k you're working, you're thinking, heck, I'll just take a loan out of my 401k because I'm paying into it every 2 weeks. Well, 401k loan programs work a little different. Not, right now, if you don't have a loan, all of your deposit into the account goes right into the investments. Well, if you take a loan out, a good chunk of that deposit now goes to pay that loan off, and it doesn't go to buy the investment. So you're setting yourself back a little bit further.
So let's thank you for those points, but I'm looking at this. It just, some of the basics just make sense. First of all, live within your means. Mm-hmm. Live on less than what you make. And that isn't any more true while you're working than it is when you retire, because now you don't have any overtime options.
Yep.
But the other thing to consider is that your budget's going to change, and you have to anticipate this. A lot of retirees find that they're surprised to learn their expenses don't necessarily decline in retirement. It just shifts to a new category. Instead of, things that I have to do, then it's things I want to do. Mm-hmm. I used to call it, for the younger investors, the disappearing car payment. You got this car payment that's $300, $400, $500 a month, and all of a sudden it's gone. Hey, I pay that car off, I'm anticipating. And all of a sudden, where did that $500 a month go? Yeah. They can't account for it because you didn't have a plan for where it was going. And it gets sucked up in wants sometimes. Yeah. And those, what I say, frivolous purchases, or,
Living
impulse,
beyond your means.
the impulse. So, taking a look at that they don't necessarily change. It's a good idea to create a living in retirement budget and forward looking, kind of take a look forward and see what you think that's going to look like, because that's different from when you used to save for retirement.
Yep.
So some of the things that are going to take that up, and the wants, I want to do this, vacations, you got, certainly you got ongoing insurance, that's unnecessary, but you got one-time expenses, you got renovations you want. You want to plan ahead on how you want to plan on doing that, and then you won't be in that situation, hopefully, where that, you're having to, tap into an emergency fund. But, don't forget all the possible expenses, such as children coming home to live, taking care of aging parents, or fund a continuing education. A lot of people find, and we teach a class, by the way, at several of the universities, University of Dayton, I've done that several times, the paranormal retirement.
Yep.
It's like a 6 or 8 week course, and you can sign up through OLLI, OLLI, Osher Lifelong Learning Institute. Very reasonable, and I also do that at the University of Cincinnati.
Yep.
So good things that you budget for, continue to learn. Well, the next one here, Eric, is, again, it's a big one, probably second only to housing.
Yep. Planning for a major healthcare expense. And I think that's all I need to say there in that case. Healthcare expense, as we get older, we spend more on healthcare. It's inevitable. If you haven't done planning and, God forbid, something big happens, there could be one expense could wreck your entire 401k. I mean, for example, in Ohio, just in a long-term care facility, if you need to go and you need assistance at a skilled nursing, I think the average is, like $82,000? That's for the bare bones.
Well, let me give you a personal story there. I managed my mother's care, also my father. My father, 11 years ago in August this year, passed away, had renal cell cancer. And, I'm also on the board now for the hospice of Hamilton and Cincinnati, and great work that those people do. We just did a hike last weekend, and if you would like to find out how you could contribute and support that organization, I can direct you to it. But I don't know what I would have done without their help. In my mom's case, she died 4 years ago in November. Well, I took her through her savings into she's a veteran, got recipient of veteran because my dad was a 2-time active Korean War vet. And my mom got benefits because of that. And then through that into the Medicaid spend down. Now, she started out in assisted living at about $2,400 a month. Then when she walked out of that facility because of dementia, I had to put her in a unit that was a complete lockdown. Well, we were probably $4,000 a month. The final phase, after she had had some falls and everything, she went into a rehabilitative and more institutional style type of place, and it was $8,000 a month. Now, looking back on that, I wish my mom had gotten the kind of policy that I own. Now, there's certainly traditional long-term care.
Yep.
And you got a budget for that. You think about Medicare. There's gaps in Medicare. Again, next month, send us an email. We'll send you a link to either be here or listen to that, because you need to plan probably for a couple about, for Plan F, which is fills the donut hole in Medicare, and that's probably $4,000 or $5,000 a year. Right? And you got to plan for that and budget. Otherwise, you're going to have these expenses again if you don't want to write a check for it by insurance. But back to this original idea, the insurance partners actually sold me a life insurance plan, the new alternative they call it, and it's a death benefit. I have $1 million of death benefit insurance, but I also have living benefits. If I'm critically, chronically, or terminally ill, I can actually spend down that death benefit before I die.
And you get to use it.
Now, there's two things I like about it. They can't cancel me, and they can't raise my premium. Two of the biggest concerns with long-term care today are those. That's why I don't want to buy long-term care, because you're going to raise my rates. And oh, by the way, you're probably right. Because if there are 92 million baby boomers and the engine of that train's 83 this year, and a caboose is 51, that train's going to keep coming into the station and driving up costs because of demand.
Yep.
And the Affordable Care Act, which is unaffordable, didn't do anything to address that.
Nope, didn't
it
help
was substantial. So again, that's the kind of plan I bought. And not that I'm recommending that to you, but you may want to check that out. Send us some information, or we'll send you some information on that.
We only have like about a minute left in the show, Rick. The last piece here, it's being tax smart. I'll call it being more tax tax efficient. So, at the end of the day, you live on your net number, not your gross number. And in retirement, everything you do, if you're drawing Social Security, could make your Social Security become taxable. So, being very smart on taxes is important.
Hey, here's a simple one. Maybe it's time to downsize and maybe do it now.
Yep.
And the last one, if you're looking for streams of income, maximizing Social Security, treating it like a pension, that's important. Well, you may want to also consider an annuity. We're not recommending these per se. I'm just saying this is an income stream that you can't outlive.
Yep.
So looking at all this in its totality, you've gotten strategies, some ideas. I know the show's never long enough to delve down into this. Contact us at info@straighttalkcleardecisions.com or call us 24/7 at 513-454-9999.
Yep.
And we'll be glad to work with you in any way we possibly can.
Yeah, check us out on social media. Remember, Facebook, it's Rick Saylor Financial. Twitter is @RickTirement, and we're on LinkedIn. So get in there, check us out. Visit our website, straighttalkcleardecisions.com.
Hey, another great show, Eric.
Yep.
You've been listening to the Straight Talk Clear Decisions radio show with your no-nonsense wealth management host, Rick Saylor.
And Eric Amberg.